Right now, 3 million vehicles are sitting in lots across America like financial time bombs waiting to explode. Dealerships know it, banks know it, but they're not telling you. These aren't just cars. They're the remnants of the biggest automotive bubble in history. And when they hit the market simultaneously, ordinary Americans will lose billions. The collapse has already started. The question isn't if this market will crash, it's whether you'll be prepared when it does. To understand why this collapse was inevitable, you need to see how the entire used car market was built on 3 crumbling pillars. Jason's $13,000 loss wasn't random bad luck, it was the predictable result of economic illusions so powerful that even experts believed them. His purchase was never based on real market fundamentals. The first pillar supporting these inflated prices was artificial scarcity created by supply chain disruptions. When semiconductor shortages crippled new vehicle production, dealers had nothing to sell. Desperate customers started competing for used vehicles like they were rare collectibles. A 2020 Ram 1500 that would have sold for $35,000 in 2019 suddenly commanded $48,000. Buyers didn't care about the premium because they needed transportation immediately. This wasn't normal market behavior, it was panic buying on a massive scale. The second pillar was interest rates, sitting near zero for years. Banks were practically giving money away, making $850 monthly payments seem manageable. A customer financing $45,000 at 2.9% interest felt comfortable because the payment fit their budget. They never calculated the total cost or considered what would happen when rates normalized. This cheap money created a generation of buyers who confused affordability with value. Monthly payment became the only metric that mattered, while actual vehicle worth became irrelevant. The third pillar was rental car companies abandoning their normal business model. Rental fleets that normally add roughly 2 million late-model units to the market paused sales entirely, effectively subtracting about 2 million supply units during the shortage. These weren't just any vehicles, they were late-model, low-mileage cars that typically formed the backbone of the certified pre-owned market. Each pillar reinforced the others in ways that seemed unbreakable. Supply shortages made people desperate enough to accept higher interest rates. Low interest rates let buyers afford the inflated prices caused by supply shortages. Rental companies hoarding inventory made both problems worse by reducing available supply even further. The system created its own momentum, pushing prices higher every month. The average used car payment jumped from $393 in 2019 to roughly $733 by late 2022. Vehicle quality didn't improve. In fact, many cars were reaching the market with deferred maintenance and higher mileage than previous years. Buyers were paying nearly double for objectively worse vehicles. This wasn't appreciation, it was mass delusion. By January 2024, all 3 pillars started cracking simultaneously. New vehicle production returned to normal levels, flooding dealer lots with inventory. Interest rates spiked from near zero to over 7% for many buyers. Rental companies resumed normal fleet rotations, dumping thousands of vehicles monthly into wholesale auctions. The artificial scarcity that drove the bubble vanished almost overnight. Most consumers still haven't connected these dots. They see individual price drops and assume it's temporary market volatility. Jason still believes his F-250 will recover its value once the market stabilizes. He doesn't understand that the market was never stable to begin with. The $64,000 he paid was never the real value of his vehicle. It was the price of a collective financial hallucination. This wasn't a natural market responding to genuine supply and demand. It was an artificial bubble created by unprecedented economic conditions that convinced millions of Americans that cars were investments instead of depreciating assets. The fundamentals never supported these prices. When normal market forces returned, the correction was inevitable. Now all 3 pillars have completely collapsed, and the market correction is accelerating beyond what anyone predicted. The artificial supports that held up inflated prices for 3 years are gone. What's happening now isn't just a price adjustment, it's the unwinding of the largest automotive bubble in American history. But those pillars aren't just cracking. One of them is being actively dismantled inside dealer finance offices. What's lurking behind the scenes is far more dangerous than falling prices. Dealers are facing something that threatens their very existence, a hidden inventory tsunami that's about to destroy their business model. While everyone watches retail prices drop, millions of vehicles are sitting in storage lots and auction facilities, waiting to flood the market in ways that will make current price drops look insignificant. This inventory comes in 3 distinct waves, each one amplifying the others. The first wave consists of lease returns from the signing frenzy of 2021 and 2022. During those years, Americans signed lease agreements they had no business signing. A nurse from Phoenix leased a BMW X5 with payments of $689 monthly when her previous car payment was $320. She qualified because lenders were desperate to move inventory during the shortage. Now that lease is ending, along with millions of others signed during the same period. These returning vehicles carry higher mileage and more wear than normal lease returns because people drove more as pandemic restrictions lifted. The second wave involves corporate fleets dumping vehicles as remote work eliminates the need for company cars. A software company in Austin just sold 47 vehicles from their corporate fleet through wholesale channels rather than dealing with retail sales. Companies across America are downsizing their fleets, rapidly sending late-model sedans, SUVs, and trucks directly to wholesale auctions to cut operational costs. These fleet vehicles carry complete maintenance records and relatively low mileage, making them attractive to wholesale buyers, but devastating to retail pricing. The third wave consists of off-lease luxury vehicles that banks refuse to put on traditional dealer lots. Instead of retail sales, financial institutions send these vehicles directly to wholesale auctions to avoid taking additional depreciation losses. A Mercedes-Benz GLK that would have appeared at a certified pre-owned dealership 2 years ago now goes straight to auction. Banks calculate that immediate wholesale disposal cuts their losses compared to retail holding costs and further depreciation. The scale of this inventory surge is staggering. Auction houses report storage capacity problems they've never experienced. The Mannheim auction facility outside Atlanta expanded their lot space twice in 8 months just to accommodate incoming inventory. Compact SUVs that typically saw 200 units per week at major auctions now regularly exceed 600 units. Full-size pickup auctions that averaged 150 vehicles weekly now process over 400 vehicles in the same time frame. Repossession volumes add another layer to this avalanche. Tom, a repo agent from Oklahoma, reports pulling vehicles faster than banks can process them. His weekly pickup schedule jumped from 12 vehicles to 19 vehicles in just 4 months. These repos join the lease returns, corporate fleets, and off-lease vehicles in the same wholesale channels, creating unprecedented volume that overwhelms traditional distribution systems. Most consumers have no idea this inventory exists because it hasn't reached retail channels yet. Dealers continue trying to sell existing lot inventory at inflated prices while wholesale markets overflow with cheaper alternatives. The disconnect between retail and wholesale pricing grows wider each month. A dealer might list a 2022 Honda Accord for $28,500, while identical vehicles sell at wholesale auctions for $21,800. This gap represents the coming retail price collapse as wholesale inventory eventually forces its way into consumer markets. Each wave amplifies the others in ways that create unstoppable momentum. Lease returns flood auctions just as corporate fleets hit the same channels. Off-lease luxury vehicles compete with mainstream inventory for the same wholesale buyers. The combined volume creates the largest vehicle dump in American history, with all of it hitting wholesale and retail markets within the next 18 months. This hidden inventory represents the physical manifestation of financial decisions made during artificial market conditions. Every lease signed at inflated values, every corporate fleet maintained beyond actual needs, every luxury vehicle financed at bubble prices now returns to market simultaneously. The timing creates a perfect storm that will force dramatic changes in how vehicles reach consumers. But the real crisis isn't just about inventory volume. The businesses that connect this inventory to consumers are facing their own financial emergency that could accelerate the entire collapse. Dealerships operate on a financing system that most consumers never see, And this hidden mechanism is now destroying thousands of businesses across America. Car dealers don't actually own the vehicles sitting on their lots. They rent every single vehicle from banks through something called floor plan financing, paying about $30 per day for each car, truck, and SUV they display. That Honda Accord on the front row costs the dealer $30 daily just to keep it there. The F-150 in the back lot generates the same daily charge. These costs never stop accumulating until the vehicle sells or gets returned to the lender. At about $30 per day, a car sitting 90 days can cost roughly $2,700 in carrying charges, and lenders are issuing margin calls when values move below outstanding loan balances. Most vehicles used to sell within 45 to 60 days, making floor plan costs manageable overhead. Today's market has extended average days on lot to over 120 days for many dealers. A dealer with 200 vehicles accumulates $6,000 in floor plan interest every single day their inventory doesn't move. That's $180,000 monthly just in financing costs before paying staff, utilities, or facility expenses. Banks impose strict rules on floor plan agreements that become devastating when vehicle values drop rapidly. If a vehicle's current market value falls below the outstanding floor plan balance, banks issue margin calls demanding immediate cash to cover the difference. Dealers face 72 hours to provide cash or surrender the affected vehicles back to the lender. Some dealers already chose surrender over financial ruin. Multiple dealers have closed permanently rather than face margin calls in the hundreds of thousands. Owners calculated that covering the margin calls would drain personal savings and still leave them with depreciating inventory in a falling market. Surrendering franchises and walking away became financially rational compared to throwing good money after bad. Desperation drives dealers to tactics that would have been unthinkable 2 years ago. Dealers offer sales staff $500 cash bonuses for purchasing any vehicle from inventory, regardless of whether employees actually need cars. They need to reduce floor plan costs more than they need profit on those sales. Other dealers sell vehicles to employees at wholesale prices, accepting losses just to stop daily interest charges from accumulating. Dealer groups with multiple locations face even more severe pressure. Some started selling vehicles at wholesale auction prices directly to consumers rather than continue paying floor plan charges on aging inventory. They calculated that breaking even on vehicle sales while eliminating daily financing costs generated better results than holding inventory hoping for retail prices. The domino effect accelerates as weaker dealers fail and their inventory flows back into the market. When dealerships close or surrender vehicles to lenders, those vehicles immediately go to wholesale auctions. Surviving dealers then compete to buy this inventory at auctions, often paying less than the original floor plan balance. This creates additional downward pressure on wholesale values while increasing inventory at remaining dealerships. Bank lending standards for floor plan financing have tightened significantly, making it harder for struggling dealers to maintain adequate credit lines. Dealers who previously qualified for unlimited floor plan credit now face reduced limits that force them to carry smaller inventories. This credit squeeze removes potential buyers from wholesale auctions, further depressing values. Floor plan financing was designed for normal market conditions, where vehicles sold quickly at predictable profit margins. Today's extended selling periods, combined with rapidly depreciating values, have turned this financing system into a wealth destruction machine. Carrying costs force desperate dealers to sell at or below wholesale, and that accelerates the crash. The surrendered vehicles from failed dealerships don't just disappear, they join an even larger wave of vehicles being seized from consumers who thought they were making smart financial decisions during the bubble years. Banks are seizing approximately 15,000 vehicles daily across America, creating the largest wave of automotive repossession since the 2008 financial crisis. This tsunami isn't just affecting subprime borrowers with damaged credit. Prime borrowers with good credit scores are losing vehicles because their monthly payments consume too much of their income after inflation destroyed their purchasing power. Tom from Oklahoma lost his Silverado after a job loss left him unable to maintain $680 monthly payments on a truck worth $8,000 less than he owed. A single mother in Florida faced an impossible choice between her car payment and rent, ultimately surrendering her vehicle to avoid eviction. These aren't isolated cases of financial irresponsibility. They represent millions of Americans trapped in loans that were structured to fail when market conditions changed. During the bubble, lenders approved 84-month financing terms with minimal down payments, creating loans that exceeded vehicle values from day one. A customer who financed $45,000 with only $2,000 down immediately owed more than their vehicle was worth. When market values dropped 20%, these borrowers found themselves trapped in loans they couldn't escape through normal sales. Financial devastation extends beyond losing transportation. Missing work without reliable transportation leads to employment warnings in professions already facing severe staffing shortages. Repossession fees often exceed 2 months of take-home pay, forcing families to choose between recovering their vehicle or paying rent and buying groceries. Each repossessed vehicle feeds directly into the inventory flood that's crashing the broader market. Banks immediately send repo vehicles to wholesale auctions rather than reconditioning them for retail sale. These distressed sales create downward pressure on auction prices, which sets benchmarks for all vehicle values. A repossessed F-150 selling for $28,000 at auction establishes pricing expectations for similar trucks in retail markets. Banks aren't waiting for borrowers to fall behind on payments anymore. They're accelerating repossessions for any technical violations of loan agreements, including insurance lapses, late registration renewals, or failure to maintain required coverage levels. This aggressive approach aims to minimize losses while vehicle values still retain some equity above outstanding loan balances. Every month banks wait potentially costs them thousands per vehicle as depreciation continues. Voluntary surrenders are increasing even faster than traditional repossessions. Borrowers realize they cannot sell their vehicles for enough money to pay off outstanding loans, leaving surrender as the only option to escape impossible financial obligations. A construction worker in Phoenix voluntarily surrendered his Ram 2500 after discovering he owed $41,000 on a truck worth only $31,000 in current market conditions. Continuing payments on an underwater loan made no financial sense. Auction data reveals the true scope of this wealth destruction. Repossessed vehicles consistently sell for 40% to 50% below comparable retail prices, establishing new baseline values that retail markets must eventually match. A repo Silverado that retailed for $38,000 6 months ago now sells at auction for $22,000, creating a pricing gap that retail dealers cannot sustain indefinitely. This repossession tsunami represents the fastest destruction of automotive wealth in American history, eliminating trillions of dollars in household net worth as families lose vehicles and remain liable for outstanding loan balances. However, cash buyers face unprecedented opportunities to acquire quality vehicles at wholesale auction prices as distressed inventory floods the market. If you're worried about being underwater, call your lender early. Banks aren't waiting, and don't rely on trade-ins as your only escape. The same economic forces destroying leveraged buyers are creating generational buying opportunities for those with liquid capital ready to deploy. But this automotive collapse isn't hitting every corner of America the same way. While some regions experience gradual adjustments, others are witnessing complete market collapse right now. Transportation industry professionals are witnessing price variations that reveal exactly where this collapse hits hardest. Vehicle haulers report dramatic regional differences that expose the geographic pattern of this market destruction. A 2021 Toyota Highlander that sits unsold at $31,000 in Los Angeles moves within 3 days for $28,500 in Birmingham, Alabama. That $2,500 difference isn't regional preference, it's the leading edge of a geographic wave that's sweeping across America. Major metropolitan areas like New York, Los Angeles, San Francisco, Chicago, and Atlanta are experiencing the first and most severe impacts because they concentrate the highest volumes of lease returns and rental fleet disposals. These cities became ground zero for inflated vehicle prices during the bubble, and now they're leading the correction downward. Urban residents who stretched financially to afford $800 monthly payments are surrendering vehicles at unprecedented rates as cost of living increases make those payments unsustainable. High cost of living cities show the steepest price drops because residents are actively downsizing their transportation expenses or eliminating vehicle ownership entirely. A software engineer in Seattle who previously drove a BMW X3 now uses rideshare services in public transportation, calculating that $300 monthly in transportation costs beats $750 in car payments, plus insurance and parking fees. This behavioral shift creates excess inventory in precisely the markets that paid the highest premiums during the bubble years. Regional price variations have created arbitrage opportunities that smart buyers are already exploiting. A Honda Accord selling for $26,500 in Denver might be available for $22,800 in Kansas City for identical year, mileage, and condition. These price gaps exist because inventory concentrations vary dramatically between markets, and information flows haven't yet equalized pricing across regions. However, buyers must calculate total landed costs, including transportation, registration, and state fees, before assuming these savings are real. A $3,000 price difference can shrink to $1,500 after accounting for logistics and paperwork. The crash spreads from urban centers to suburban and rural areas through predictable channels. Suburban dealers initially resist wholesale price pressures from urban markets, but floor plan financing costs eventually force them to match metropolitan pricing. Rural markets lag behind by roughly 3 to 6 months as lower inventory turnover delays the impact of falling wholesale values. This geographic timing creates windows where rural buyers pay urban prices for vehicles while rural sellers still expect bubble-era values. Florida and Texas are experiencing some of the steepest declines despite their reputation for stable automotive markets. Population shifts from expensive coastal states initially increased vehicle demand in these regions, but job losses and economic pressures are now reversing those trends. Florida's tourism-dependent economy has reduced discretionary spending power for vehicle purchases, while Texas' energy sector volatility affects employment in major metropolitan areas like Houston and Dallas. Regional economic factors either amplify or dampen the crash, depending on local employment conditions and demographic trends. Areas with stable manufacturing or government employment see gentler price declines, while regions dependent on volatile industries experience accelerated drops. A General Motors plant closure affects vehicle values within a 50-mile radius more severely than national market trends would predict. California leads the nation in both price declines and inventory concentrations, making it the primary indicator for national market direction. When California auction prices stabilize, it signals that the worst of the correction has passed for most other markets. Conversely, continued California price drops indicate that the national correction has further to go. This gives buyers and sellers a simple monitoring tool. Watch California wholesale auction results to predict what's coming to your local market. Rural areas that haven't felt the full impact yet may actually suffer more when the collapse finally arrives. These markets maintained artificial pricing longer, meaning the eventual correction could be more severe and concentrated. Small-town dealers with limited floor plan credit and fewer financing options face particular vulnerability when distressed inventory finally reaches their markets. Understanding geographic timing patterns could save buyers thousands by shopping in markets where the correction has advanced furthest while avoiding regions still experiencing peak decline phases. The key involves monitoring wholesale auction results from major metropolitan areas and timing purchases accordingly. But geography isn't the only factor determining who wins and who loses in this collapse. Financial qualification determines who can participate in this market collapse. Banks have quietly transformed their lending standards, shutting out millions of qualified buyers who would have easily secured loans just 18 months ago. Even borrowers with pristine credit histories now face rejection rates that would have been unthinkable during the bubble years. The credit squeeze is eliminating buyer demand faster than falling prices can attract new customers, creating a liquidity crisis that's accelerating the market collapse. Daniel discovered this harsh reality when he attempted to finance a certified pre-owned Lexus RX 350. With a 770 credit score and a stable income, Daniel expected routine loan approval. Instead, lenders offered him 6.9% interest with a 20% down payment required. Just 2 years earlier, his identical credit profile qualified for 3.5% financing with minimal down payment. The new terms would require $8,000 cash up front for a vehicle he could have financed with $2,000 down during the bubble years. Banks implemented these tighter standards without public announcements, quietly raising credit score requirements by roughly 50 points across most lending tiers and demanding much larger down payments than 2 years ago. Borrowers who previously qualified for prime lending rates now face higher interest brackets for identical credit profiles. The payment impact is devastating. A $35,000 loan at 3.9% for 72 months costs $539 monthly. The same loan at 8.5% costs $634 monthly, adding $95 to every payment. That difference eliminates millions of potential buyers whose budgets cannot absorb the additional cost. Interest rate increases have effectively doubled or tripled borrowing costs for most buyers since the bubble years ended. Customers who secured 1.9% promotional financing in 2022 now face rates exceeding 9% for similar vehicles and credit profiles. This rate shock transforms affordable purchases into financial impossibilities. A buyer who qualified for $650 monthly payments at low rates cannot afford the same vehicle when rates triple their financing costs. Rebecca, a loan officer at a major credit union, reports unprecedented scrutiny on applications that would have been automatically approved last year. Her institution now requires extensive income verification, employment history documentation, and debt-to-income calculations that eliminate borrowers who previously qualified easily. The approval process that once took hours now requires days or weeks, and many applications face rejection for reasons that weren't disqualifying factors during the bubble. Falling vehicle values combined with tight credit standards create a dangerous liquidity spiral. Banks refuse to lend more than current vehicle values, but those values change daily as the market drops. Fewer buyers means more inventory sits unsold, forcing prices lower, which triggers more defaults and tighter lending standards. This cycle feeds on itself, accelerating the collapse. Millions of potential buyers are completely eliminated from the market through this credit squeeze. Subprime borrowers with credit scores below 650 face rejection rates exceeding 85% compared to 45% rejection rates during the bubble years. Even near-prime borrowers with scores between 650 and 700 struggle to find financing options that don't require massive down payments or impose punishing interest rates that make purchases financially impossible. Dealers report unprecedented difficulty finding financing for customers who would have been easily approved last year. A Toyota dealer in Phoenix spent 4 hours calling different lenders for a customer with a 690 credit score and steady employment history. All 7 contacted lenders either rejected the application or offered terms the customer couldn't afford. This same customer would have had multiple financing options available with competitive rates during 2022 market conditions. Traditional financing channels have essentially disappeared for most buyers seeking vehicles over $25,000. Credit unions that previously offered competitive rates now limit auto lending to existing members with perfect payment histories. Banks that encouraged long-term financing now refuse loans longer than 60 months for used vehicles. Buy here, pay here lots charge interest rates exceeding 20%, making them viable only for desperate buyers with no alternatives. This credit crunch is creating the ultimate buyer's market for cash purchasers, while trapping everyone else in their current vehicles regardless of their transportation needs. If you're a cash buyer or already have pre-approved credit, you'll get unprecedented leverage. If you depend on financing, prepare for fewer options and higher down payment demands. But even cash buyers need to understand exactly when this market will hit absolute bottom. Market timing separates financial winners from losers in this collapse, and the opportunity window operates on multiple time horizons that most buyers will completely misunderstand. Sarah Mitchell, a financial planner from Charlotte who manages $180 million in client assets, has been tracking automotive market cycles for over a decade. She positioned her clients to avoid the bubble entirely, and now she's preparing them to strike when conditions create maximum advantage. Sarah's strategy involves understanding how seasonal patterns, model year transitions, and inventory cycles create compressed windows of seller desperation within the broader multi-year correction. Seasonal patterns amplify the crash during predictable months when dealer desperation peaks. January and February traditionally represent the worst months for vehicle sales as consumers recover from holiday spending and face tax preparation expenses. This year, those seasonal pressures compound with inventory overflow from holiday sales that never materialized. Dealers entering January with bloated inventory face immediate floor plan financing pressure that forces aggressive pricing. February intensifies this pressure as dealers realize the spring selling season won't rescue them from their current predicament. March through May typically mark recovery periods for automotive sales, but this year's crash disrupts normal seasonal patterns. Dealers who usually rebuild inventory for spring buyers instead focus on clearing existing stock at any price necessary. May becomes particularly critical because it marks the end of the traditional model year clearance period, forcing dealers to accept wholesale losses rather than carry aging inventory into summer months. Model year timing creates additional pressure waves that smart buyers can exploit. Dealers face dual inventory pressures as 2024 model year vehicles arrive, while 2022 and 2023 models continue aging on lots. This creates generational pricing conflicts where dealers cannot maintain premium pricing on older inventory when newer models offer competitive pricing. The mathematical reality forces dealers to price 2022 models below wholesale values to move inventory before financial costs eliminate all profit margins. These seasonal and model year mechanics create recurring windows of heightened seller desperation that feed into the larger correction cycle. While short-term opportunities appear during traditional clearance periods, the deepest discounts require patience for the broader market correction to reach its trough. Based on industry analysts and automotive insiders, the most significant opportunities will likely emerge in late 2025 through early 2026, with January through March 2026 frequently cited as the probable bottom for this correction cycle. Market bottom indicators become visible through three clear signals that buyers can monitor without complex analysis. First, wholesale auction prices stabilizing for multiple consecutive weeks signals that distressed inventory has reached maximum absorption capacity. Second, repossession and voluntary surrender volumes declining month over month for several months indicates that the most financially stressed borrowers have already lost their vehicles. Third, retail and wholesale price gaps narrowing toward historical norms suggests market equilibrium is returning. Currently, these gaps exceed 35% in most vehicle categories, indicating significant retail price drops are still coming. Wholesale auction data indicates maximum inventory flood timing occurs between March and June, when lease returns, corporate fleet disposals, and repossession volumes peak simultaneously. This convergence creates the highest wholesale inventory levels in automotive history, establishing pricing benchmarks that retail markets cannot resist much longer. Weekly auction volumes that typically see 10,000 units nationally now regularly exceed 25,000 units, creating pricing pressure that wholesale buyers cannot absorb without significant discounts. Financial positioning for maximum advantage requires specific preparation steps executed before optimal windows open. Build substantial cash reserves or secure pre-approved financing from credit unions, which typically offer more favorable terms than traditional banks. Monitor wholesale auction results from major metropolitan markets, as these provide leading indicators for national pricing trends. Cash buyers gain immediate negotiation advantages and can close transactions within days of identifying opportunities. The convergence of seasonal desperation, model year pressures, and inventory floods creates compressed periods where motivated sellers meet reluctant buyers. These windows repeat annually but operate within the broader correction cycle that determines overall price levels. Understanding both time frames allows strategic buyers to maximize their advantage during peak opportunity periods. Timing matters tremendously in this market. Miss the bottom and you lose tens of thousands in potential savings. But get this right and you could secure what amounts to a generational deal. The question becomes whether you'll be positioned as a winner or victim when this historic wealth transfer reaches its conclusion. Market preparation determines your outcome in this historic wealth transfer. This automotive collapse represents the largest shift of vehicle wealth in modern American history. Millions of families will lose fortunes as their vehicles become financial anchors, dragging them underwater, while prepared buyers with cash and timing knowledge will acquire assets at generational discounts. Your action plan requires 3 immediate steps. Accumulate cash reserves and prepare to act quickly when opportunities emerge. Get pre-approved financing from credit unions or existing banking relationships before optimal windows open. Monitor wholesale auction signals in major metropolitan markets, particularly California results, which serve as national indicators. Watch for convergence signals in late 2025 to early 2026, with January through March 2026 often cited as the probable market trough. Comment below whether you're buying, selling, or holding, and subscribe for updates as this market unfolds. This collapse will shred wealth for the unprepared and hand huge bargains to those who plan. Decide which side you'll be on.